Welcome back, ladies and gentlemen. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio WFLA. This segment of the program, we're going to talk about some of those tax traps that exist no matter what at pretty much every age. Every age, if you think of it, sort of has a little bit of a different tax trap. We're going to hit some of the more popular ones that spring up at different ages so that you're aware of them, particularly if maybe you've got a birthday coming up or something like that. I've got a birthday coming up here in a week or so. So in one of these ages, and I'll let you guess which one it is, has an additional tax trap that comes with it. So let's begin. We'll start with the kids. So clearly we're not in that age group. The kiddie tax applies for children, infants, newborns, on up to age 23. And what the kiddie tax is it basically is a mechanism where the IRS does not like it when parents or grandparents try to push income onto a kid's return, thinking that that kid's return is going to be a lower tax rate than theirs. So specifically, the kiddie tax was invented to make sure that that does not happen. And what it is it hits unearned income. So think investment income, dividends, capital gains, interest, things like that. It hits unearned income up until age 24. So between 0 through age 23 up to age 24, you are basically that income, to the extent that that unearned income is over $2,200, that income then is taxed at the parent's highest marginal tax rate. So kiddie tax, obviously very unique. It applies to typically investment income, unearned income. It's not going to apply to the kid's summer job, assuming they can find one this summer. The reality is that that really relates to unearned income or more investment income. So designed to make sure that that income still gets taxed just like it would appear on the parent's rate. Big change of late, the prior couple of years, the estate tax rates have applied. This year we're back to kind of that traditional format of the kiddie tax where it's the highest marginal rate that is on the parent's tax return. So that one's kind of had a little bit of a flip over to estate tax rates for a period of time in the past couple of years, and then flip back to sort of the way that it was. Bottom line, if it's unearned income and it's a kid, they're going to have to pay it at a much higher rate than if it was just their income on their own return. So that's important to know. The next sort of age group is either the 18 or the 21-year-olds. 18 here in Florida. It depends on what state you're in as to whether it's 18 or 21, but generally in Florida, age of majority is 18. That means on a custodial account, meaning a minor's account or something like that, that was set up for the benefit of a child, that money automatically becomes theirs. And in fact, the state law recognizes it such that if you are the parent and you set up a minor's account, the second that kid turns 18 here in Florida, you no longer have any say whatsoever on the account. You can't move it, you can't take money out, you can't even readjust the investment allocation of it. That's how stringent the law is, or the tax trap is, at 18 on a minor's account. The kid turns 18, it's automatically theirs, no matter what. So be aware of that you no longer get the say in that account, at least from a legal point of view. Next age up would be 30. Okay, I haven't quite hit my birth age yet, given my birthday coming up next week. 30, okay, is a Coverdell Educational Savings Account. If you own a Coverdell Educational Savings Account, which is a type of account that you could set up to help fund college expenses, guess what? Within 30 days of turning age 30, all of the money must be distributed out of that account. If it's not used for education, it is taxable with a penalty. So understand that if you've got an old educational savings account laying around, or maybe the kids have one and they just didn't use all of it on an educational savings account, you have to have taken the money out 30 days before your age 30. Different from a 529 or other types of college savings types of vehicles, but a Coverdell educational savings account has a specific tax trap in it that springs up at age 30, that if you don't take the money, then you've got to take the money before you turn age 30. Next age up, age 50. Age 50, that's when you can start to put more money into your retirement account. So if it's a 401k, 403b, deferred comp, you get to put an extra $6,500 in on top of the normal contribution for the year 2020. If it's a simple, it's $3,000. If it's an IRA or a Roth, it's an extra $1,000 that you can contribute. So for the example of an IRA or Roth, where the contribution limit is $6,000. Once you turn age 50, you can do an extra $1,000 on top of that and ultimately be a total of $7,000 into that IRA or into that Roth. So next up, 55. So at 55, age 55, the tax trap there is that if you retire, you can get access to your employer-sponsored retirement plan without a 10% penalty for early distribution, but only if you're taking the money out of said employer retirement plan. If you take the 401k or 403b or whatever it is and roll it over to an IRA, that tax trap will spring up and bite you because it only applies to a qualified retirement plan if you're retiring over the age of 55, or in the year in which you turn age 55 is the technical rule. Then you can get money out of that retirement account and not have to worry about a 10% penalty. That's very unique on a qualified retirement plan provided by an employer. Doesn't apply on an IRA, so beware of that tax trap. 59 and a half, of course, next age up is the age where you would have no penalty on being able to take money out of a retirement account, no matter what type of retirement account it is. Next up, 62. That's the age where you can take your Social Security early. It's obviously subject to reduced benefits, but at 62 is the earliest age in which you can take your Social Security. 65 would be the next stage. Why is that important? Well, that's where you get eligible for Medicare. And certainly if you've had to pay for your own health insurance, you know 65 Medicare, there's definitely a price savings or a cost savings in going and getting on Medicare versus being having your own policy, particularly if you're in your early 60s. Full retirement age under Social Security, age 67. That's the age where you would not be subject to any reduction whatsoever. Similarly, age 70 is if the maximum age that you can postpone your Social Security until in order to maximize out your benefits. Now, the last age we'll throw out there, your required minimum distribution. Used to be 70 and a half. Now it's 72. Of course, this year's kind of all tossed up in the air because it has the required minimum distribution has been suspended for this year, but going forward, the required minimum distribution age is going to be 72. So lots of different ages there, starting all the way from 0 all the way up to 72 in terms of some different tax implications or really tax traps. If you aren't aware of these ages and what kicks in at certain ages, then you may very well find yourself paying more in taxes or perhaps not saving as much on taxes as you might otherwise have had the opportunity to do. So just be aware, a lot of tax traps out there. No matter your age, there's always something that might be lurking out there. So we just kind of covered some of the basic ages and some of the basic tax traps that exist. But interesting to note, no matter how old you are, there's always a little bit of a trap from the IRS. So beware of that, particularly as you turn these ages, right? Then you may want to adjust your planning for those changes in ages as well. So we're going to take a break. During the break, we'll listen to some messages from various people, including one of our ads. So that's always a good thing. And then when we get back, we will continue the conversation. When we get back, we're going to talk about kind of stay on this tax topic and talk about some of the tax pitfalls to be aware of if you're trying to access money in today's world. So stay tuned for that here on the program. This is Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando.